Do you want to beat 98% of Wall Street investors? It's simpler than you think. Read the annual report. And if you read the footnotes, you've done more than 100% of them. Warren Buffett doesn't start with CNBC, he starts with company reports. That's his number one source of truth. In 9 steps, I'm going to show you a checklist that you can use to read annual reports. And this way, you really get what truly matters. This is the value investor here. I help people save and invest intelligently. So, this is the first thing that I've learned, and this is from Jim Rogers. Jim Rogers is worth an estimate of about 300 million, and he says that when you read annual reports, you should read the footnotes as well. And I know a lot of people say, who does that? It's only the lawyers and people who draw up very complex contracts who read footnotes. But footnotes in annual reports contain a lot of information, and by reading them, you're actually ahead of about 100% of Wall Street. Buffett says annual reports are the main source of truth. He says, I read annual reports of the company I'm looking at. Warren Buffett just doesn't end there. He will read those reports, and he will also read the annual reports of competitors. And he calls this the main source of material. And this is actually true if you look at it, because you might be invested in a company, but if you read the annual report of a competitor, you will see that they're doing something that's actually better than the company you're invested in. And this will give you more insight into what you're investing and enhance your circle of competence. So I'm going to show you how to read an annual report. Reading annual reports is not like reading a novel. So going about it page by page is not really effective. So if you stick around, I will show you exactly how to approach this using a 9-step process. So the first one is confirm the basics. This might sound obvious, but mistakes here can actually lead to wrong conclusions later. So make sure that it's the right period that you want to look at, and also make sure the currency in there is used. For European reports, they will be using euros instead of dollars. So make sure that you get this straight, and this will help when you're making conclusions later. Number 2, understand the business. So before you look at the numbers, you need to understand how the company makes money, where this money comes from, what it actually sells, and how much of each particular category it sells. Where does the revenue come from? If you can't explain the business clearly, then you're not ready to judge the numbers. The next one is look at the balance sheet. So the balance sheet is very important because it gives the financial health of the company. So look at it as a document that has the net worth and the financial strength of the company. So look for signs of strength or stress. How much debt does the company carry? Can it pay its short-term bills? And goodwill, which is the difference between the purchase price of a company and the actual separable assets of that company. Goodwill is normally known as the intangible asset because you have paid more than the actual tangible assets. So if a company has too much goodwill on its balance sheet, this can be a warning sign that something is not right. The next thing is analyze the income statement. So the income statement shows you how much profit the company has made from the sales that have been made, and it shows also the cost of goods sold or cost of earnings. How high are the costs to produce the products or services? So you are looking at the gross margins, you're looking at the net margins as well, making sure that these are rising and not falling, making sure that revenue is also rising. Yes, and does the company turn a good portion of revenue into profit? So this is very important because if margins are squeezed, if margins are depressed, then it means that the company might actually be dying, or it might be getting pressure from competitors. Also look at the cash flow statement. That's the other thing. So cash is very hard to manipulate. Cash tells the truth. You want to ask these questions. Do earnings turn into real cash? Is free cash flow positive and growing? Has cash on hand improved from last year? If it's falling, then it means that the working capital is getting smaller. So you want to make sure that the cash is cash flow is positive and it's growing. And I usually look at the free cash flows. Those free cash flows are even harder to manipulate than the actual cash. So read the footnotes, and I've said this before, this is where you discover the hidden gems. How much stock-based compensation is given to employees? You want to understand this because it shows you how much your ownership is going to be diluted if this happens. When do debts come due, and is refinancing a risk? Footnotes help you to understand what is not obvious from the main pages. After reading the footnotes, you need to confirm the units, and this follows on from what I've said earlier. You need to double check ownership details. How many shares are in existence? You want to invest in a company which gets its share count down, not the other way around. So how many shares are in existence today? Does the company have preferred shares? If so, are these preferred shares convertible to ordinary stock? Are acquisitions paid with stock? Because this also dilutes the ownership that you have in a company. So share count matters because dilution can quietly reduce your ownership. So this is why I like companies with aggressive buyback programs, because my ownership in that company is improving as the company is buying back its shares. The other thing is review corporate governance. In corporate governance, this is really about the management of the company. So management, you want to look at things like management acting like owners of the business. Do they have a sizable investment in the company they are running? Because if they have, then they've got skin in the game. Do insiders own meaningful shares? Are they selling or are they buying? You want to look at, do executives have special rights or privileges? Good governance creates long-term alignment between management and shareholders. So you always want managers that are shareholder oriented, and by being shareholder oriented, managers are putting the needs of shareholders first. They're doing things that increase the value or unlock the value of shareholders. So reading annual reports is not fun, it's not something that is enjoyable, but this is how legends like Buffett, Lynch, and Pabrai get their edge. If you want to invest with confidence, start where they start, with the facts, not the forecasts. Master this skill and you'll be miles ahead of the crowd. If you've enjoyed this video, do me a favor, press the like button and subscribe so that you can see more of this content, and this content can be pushed to more people who want to be financially successful like you. See you in the next one. Cheers.